I want to start with something nobody told me when I was working in banking. In 2019, a couple came into my branch to get pre-approved for a mortgage. Young, solid jobs, excited. We approved them for $380,000. They bought at $374,000. I remember watching them leave with the paperwork and thinking, good for them. 2 years later, I ran into the wife at a coffee shop. The roof had failed. The HVAC needed full replacement. They'd put $28,000 on credit cards in 18 months just to keep the house livable. She said, and I'm quoting her directly, "I wish someone had told me the real numbers before we signed." That conversation is why I'm making this video. Because right now, in 2026, everyone is telling you to stop renting. And some of you absolutely should. But some of you are going to make the exact same mistake that couple made. And I'm not going to let that happen without at least giving you the real math first. Let's start with the numbers. The actual ones, not the ones a realtor puts in a brochure. According to Federal Reserve Fed data, the median home price in the US hit $419,000 in early 2026. In 2019, that same number was $248,000. That's a 69% increase in 7 years. Not 10%, not 20%, 69%. At the same time, the 30-year fixed mortgage rate, also tracked by Fred, is sitting just above 7%. For context, in January 2021, that rate was 2.65%. Your parents bought their house in a completely different financial universe. The advice they give you is not wrong. It's just from a different planet. Here's what 7% actually means on paper. A $380,000 loan at 7% for 30 years is a monthly payment of roughly $2,529. Before property taxes, before homeowner's insurance, before the inevitable weekend where something breaks and costs you $3,000 to fix. And before anyone says, but rents are high too. Yes, they are. The Zillow Rent Index puts the average US rent at around $1,702 in 2026, up 26% from 2020. I'm not pretending renting is cheap. It's not. But comparing two expensive options is exactly how people make bad decisions. Here's the part that changes how people think about this. And I want you to actually sit with this number. On that $380,000 mortgage at 7%, your very first payment is $2,529. Of that, $2,217 goes to interest. $312 goes to your equity. That's it. You are building $312 of ownership in a $380,000 asset with a $2,529 check. Now, does that change over time? Yes, absolutely. By year 15, you're splitting closer to 50-50. By year 25, most of your payment is equity. That's how amortization works. But in the first 5 years, you are predominantly paying the bank, not building wealth. This is not a reason not to buy. It's a reason to understand what you're actually buying. And here's the calculation almost nobody runs before they fall in love with a house. There's a concept called the break-even point. That's the number of years you need to stay in a home before buying it financially beats renting. The New York Times publishes a free rent versus buy calculator. It uses real local data. Run your city through it right now if you're watching this. In most US markets in 2026, that break-even is between 6 and 8 years. Under 6 years, and the math, cold, unemotional math, typically favors renting and investing the difference. And I've watched people who didn't know that number buy, sell at year 4 because life happened, and lose $40,000 they didn't know they were gambling. This is the section realtors hate. And I don't care. Do not buy a home right now if your down payment would leave you with less than 3 months of expenses and savings. I'm not being conservative here. I'm being realistic. The average unexpected home repair in the first year costs between $1,800 and $5,500. According to the American Housing Survey, 28% of homeowners experience a major unplanned repair in their first 12 months. If you close on a house with $2,000 in savings, you're one broken water heater away from high-interest credit card debt. That is not homeownership. That is a very expensive trap. Do not buy if you're not planning to stay for at least 5 years. I know you think your life is stable. Things change. Job offers come from other cities. Relationships end or begin. Don't lock yourself into a financial instrument that takes 6 years to break even when you can't honestly say where you'll be in 3. And do not buy at the top of what the bank approves. Banks will approve you for significantly more than you should spend. Their job is to lend money. They are not looking at your car payment, your student loans, the fact that you want to take a vacation, or the reality that your income might not grow as fast as you hope. The bank approved that couple from my bank for $380,000. Their comfortable number, the one that would have let them sleep at night, was closer to $290,000. Now the other side. Because there is a real case for buying, and I don't want to talk you out of something that's right for you. The Federal Reserve's Survey of Consumer Finances, published every 3 years, one of the most credible data sets in personal finance, found that the median net worth of homeowners is $396,200. The median net worth of renters is $10,400. That's not a typo. That gap is real, and it's been consistent across decades. Now, does that mean buying causes wealth? Not exactly. Higher income people buy homes more often. But here's what's undeniable. Homeownership forces savings. Every mortgage payment builds equity. You can't accidentally spend it like you can spend a savings account. Over a 20 or 30-year horizon, that forced savings mechanism is genuinely powerful. The markets where buying currently makes the most financial sense, based on price-to-rent ratios, are mid-sized cities in the Midwest and Southeast: Columbus, Ohio; Raleigh-Durham, North Carolina; Birmingham, Alabama; Huntsville; parts of Texas outside Austin proper. These are markets where the break-even timeline is shorter, appreciation is growing, and the monthly cost of owning versus renting is closer to parity. If you're in San Francisco or New York, the math is brutal for buyers right now. If you're in Raleigh with a 5-year plan, 20% down, and a solid emergency fund, the math works in your favor. Geography matters more than most YouTube finance videos will tell you. 4 questions. Answer them honestly. 1. If you subtract your down payment and closing costs from your savings today, do you still have 3 to 6 months of expenses left? If no, wait. Save more. This is not negotiable. 2. What does the NYT rent versus buy calculator say for your specific city at your specific price point? If the break-even is over 8 years and you're not sure you'll stay that long, the math says rent. 3. What is your credit score? According to Federal Reserve data, the difference between a 680 and a 740 credit score on a $350,000 mortgage at current rates is approximately $90 per month. Over 30 years, that's $32,000. 6 months of focused credit improvement, paying down utilization, removing errors from your report, can save you more than most investment returns. 4. Are you buying because the numbers work or because you feel behind? Because feeling behind is not a financial strategy. It is a feeling, and it will cost you more than rent ever did. I want to be honest about something that doesn't fit neatly into a calculator. There is value in stability that doesn't show up in a spreadsheet. Your landlord can't raise your rent 40% at renewal or decide to sell the building. You can paint the walls. You can get a dog without a pet deposit. You can plant things in a garden and they'll be there next year. These things matter. They're real. They're part of the equation for a lot of people, especially families. And there is something genuinely powerful about owning the place where you live, not as a financial instrument, just as a human being. I've talked to hundreds of people about their finances over the years, and the ones who own their homes, even the ones who bought at slightly wrong times, almost universally feel more financially grounded than renters who earn the same income. That doesn't override the math when the math is clearly wrong. But when the math is close, when you're at that break-even edge, the stability and the psychological grounding of ownership can be the deciding factor. And that's a legitimate reason to buy. 3 things that turn homeownership into a financial disaster. Fast. First, waiving the inspection to win a bidding war. I have watched this go badly more times than I can count. A $400 inspection can reveal $40,000 in problems. No bidding war is worth that risk. Walk away from any deal where the seller demands you skip it. Always. Second, using a home equity line of credit for non-home expenses. The moment people have equity, some of them immediately access it for cars, vacations, renovations that don't add value. Your equity is your foundation. The house is not an ATM. I've seen people pull equity to fund lifestyles, hit a market correction, and end up underwater on a mortgage they couldn't sell their way out of. Third, buying a home as an investment first and a home second. Yes, real estate builds wealth, but your primary residence is where you live, not a rental property. People who buy purely chasing appreciation end up in houses that don't fit their life, in locations that don't work for their job, stressing about market conditions instead of just living. Buy a home to live in it. Buy investment properties separately, later, when you know what you're doing. Here's what I want you to do tonight. Go to the NYT Rent versus Buy calculator. Free, no email required. Link is in the description. Put in your actual numbers, your city, your realistic home price, your current rent, your planned years of stay. See what it says. If it says buy, run the readiness checklist I gave you. Emergency fund, credit score, stable timeline. If it says rent, that's not failure, that's information. Renting while investing the difference in index funds is a legitimate wealth-building strategy. It is not throwing money away. It is making a rational decision with the numbers you actually have. The goal is not to own a home. The goal is financial security. For some of you, buying gets you there faster. For others, it sets you back years. Know which one you are before anyone puts a pen in your hand. Your future self will thank you.